Hey traders, welcome back. Today we're breaking down supply and demand zones, the cleanest support and resistance signals you'll ever trade. Two zone types. Demand zones are price levels where big buyers absorb selling. They cap downside moves. Supply zones are where big sellers absorb buying. They cap upside moves. Price tends to oscillate between them. When price returns to a fresh zone, the same buyers or sellers react again. That's your trading edge. These aren't theoretical levels, they're institutional footprints. Every demand and supply zone you see on a chart represents real orders, real positioning, by traders who control billions in capital. When you learn to spot them, you start trading with the institutions, not against them. By the end of this video, you'll spot zones in seconds, time the entry, and know exactly when to skip. Look at Tesla on May 4th. For 3 straight sessions, Tesla closed in a tight $10 window between $385 and $395. And that's the textbook signature of institutional accumulation. Then over the next 4 sessions, Tesla rallied straight to $428 by May 8th. A clean 10% breakout confirming buyers were committed. Now watch what happens 2 weeks later. On May 19th, Tesla pulls back and returns to that exact same base level. Over the next 3 days, Tesla bounces 10.6%, proving the same buyers were still defending that zone. That's a demand zone in action. Let me show you exactly how to spot one before the bounce happens. Here's the mechanic. A demand zone forms in 3 distinct parts. The first part is a tight range. You'll see 3 or 4 bars all closing at roughly the same price level. And that's the signature of institutional accumulation. Big buyers are loading positions at one price because they can't market buy the whole position without moving price against themselves. So they sit at the bid, quietly taking every share retail sells. The second part is an explosive move out, a rally of 5% or more in just 1 to 3 sessions. That's confirmation the buyers were real and they're done loading. And the strength of that move tells you exactly how much demand was sitting at that level. The third part is the retest. Over the next 2 to 3 weeks, price drifts back to that same level. And this is your trading opportunity. But there's a fourth element that determines whether the trade works, what actually happens at the retest itself. If the buyers are still there, they reload, and price bounces with the same force as the original move. That's the trade. The entire mechanic depends on one thing. Institutions don't just buy once, they defend their level. So your job is simple. Spot the base, wait for the retest, and anticipate the defense. Every demand zone that holds follows this exact pattern. Every demand zone that fails violates one of these 4 steps. Memorize the structure. Here's our first example. Tesla on May 4th. For 3 straight sessions, Tesla closed in a tight $10 range between $385 and $395, a textbook accumulation base. Then over the next 4 sessions, Tesla rallied straight to $428 by May 8th, a clean 10% move in a single trading week. That's the explosive confirmation we're looking for. After that came 2 weeks of digestion and then the test. On May 19th, Tesla pulled back and printed a low of $393.63, touching the upper edge of the May 4th base. The same buyers stepped right back in. By May 22nd, Tesla hit a high of $431.51. That's plus 10.6% in just 3 trading days. The trade was simple. Anticipate the retest near $394. Place your stop just below the zone at $383. $11 of risk against $37 of reward. A clean 3-to-1 trade. Here's our second example. Broadcom on April 17th. Tight base again, this time a $7 range between $399.81 and $406.73. Same setup, different ticker. Over the next 4 sessions, Broadcom rallied, closing at $399 the next day, then jumping to $422.65 by April 22nd. That's a 5% breakout, confirming the buyers were real. Then came the digestion phase, 10 full days of pullback. By April 28th, Broadcom closed at $399.83, right at the bottom edge of the original zone. The retest was textbook, and then the defense happened. Over the next 4 trading days, Broadcom climbed back to $433 by May 5th. That's plus 7.2% off the retest low, all in a single trading week. The trade plan was straightforward. Anticipate the retest near 400, place your stop below at 390, and target the prior swing high. $5 of risk against $33 of reward. A 6-to-1 trade. Same mechanic, different ticker, same clean outcome. Tesla and Broadcom both confirm the pattern, and this pattern repeats every single week in liquid names. Now flip the chart upside down. The supply zone is the mirror image of the demand zone. Same three parts, just opposite direction. The first part is a tight range, but at the top, and instead of accumulation, this is institutional distribution. Big sellers are offloading positions at one price. They can't market sell the whole position because that would crash the bid. So they sit at the ask, hitting every retail buyer that comes in. The second part is an explosive drop, a 3 to 5% decline in just 1 to 3 sessions. That's your confirmation the sellers were committed. And the strength of that drop tells you exactly how much supply was parked at that level. The third part is the retest. Price climbs back up to that same level. And that is where you short. But there's a fourth element that determines whether the trade works. What actually happens at the retest itself? If the sellers are still there, they reload, and price gets rejected with the same force as the original drop. Demand zones catch falling prices. Supply zones cap rising prices. That's the entire concept. The trade direction flips, but the mechanic is identical. Spot the tight range, wait for the move, anticipate the retest, and trade the defense. One mechanic, two directions. Master this one pattern, and you'll cover 90% of institutional setups. Learn it, drill it, and you'll see it every single trading week. Here's our supply example. Microsoft on April 28th, tight top, an $8 range between $421.90 and $429.92. That's classic institutional distribution. Then over the next 2 sessions, MSFT dropped, crashing to 407.78 by April 30th. That's a 4% decline in a single session, telling us the sellers were committed. After that came 4 days of weakness, followed by the climb back. On May 4th, the retest happened. MSFT rallied to a high of 420.78, touching the bottom of the April 28th zone, before closing at 413.62, right back below the supply low. The same sellers reloaded. By May 11th, MSFT hit a low of 405.11. That's minus 3.7% from the retest. Clean defense. The trade plan was the inverse of the demand setup. Short the retest near 420, place your stop above the zone at 431. $11 of risk against $15 of reward. This is the mirror image of the demand setup we just covered. But the rule doesn't always work. And if you don't know when to skip a setup, supply and demand will eat your account. So let's look at one that Shopify on April 29th. Clean base between 119.42 and 122.03, the same setup as the wins. Over the next 4 sessions, Shop rallied, closing at 127.67 on May 1st, then 127.55 on May 4th. That's a 5% move out of the zone, and the pattern looked legitimate. You would have been tempted to wait for the retest. But here's what actually happened on May 5th. There was no retest. Shop gapped down and opened at 116, already 3% below the zone before a single trade had executed. Then price dropped straight through the base and closed at 107.63. That's 14% below the base by close. No bounce, no pause, no defense. Catastrophic. So what killed this trade? Context. The broader market was rolling over that week. SPY was breaking down on the exact same day. Shop was already in a downtrend, not a range. And the volume on the failure candle was 3 times the prior average, meaning institutions were liquidating, not just retail traders panicking. So the same exact technical signal as Tesla, Broadcom, and Microsoft produced a completely different outcome. Different broader environment, different result. That's why every zone trade starts with 2 checks. First, is the broader market ranging or trending against you? Second, is volume on the failure candle anything unusual? Those 2 filters would have kept you out of this trade. A brutal lesson, free from someone else's chart. 2 filter rules. Memorize them. Use them every single trade. Rule 1. Only trade fresh zones. Fresh means never been retested before. All the institutional orders that built up during the original base are still parked there, untouched, waiting. Once a zone has been hit and bounced or rejected, most of those orders got filled. The next time price comes back to that level, the supply or demand is much thinner. The bounce is much weaker. By the third retest, the zone is dead. Rule 2. Check the daily chart context. Is the broader market ranging, moving sideways, or in a slow drift? Or is it trending hard in one direction? Ranging markets respect levels. That's where zones hold. That's where you want to trade. Strong directional trend against the zone. Skip it. The trend wins. You can have the cleanest zone in the world, but if the broader market is dropping 1% a day every day, your zone will get sliced through. Both filters green, you take the trade. Either filter red, you stay out. That's how you keep your edge over time. Your playbook. 5 steps. Print this and tape it next to your monitor. Step 1. At the end of every trading day, scan your favorite tickers. Look for a small base, 1 to 3 tight bars where the daily range is under 3% of price. That's the institutional fingerprint. Step 2. Wait for the explosive move. 5% or more rally for demand zones, or 5% or more drop for supply zones. That's confirmation the institutions are committed. Step 3. Mark the high and low of the base. That becomes your zone. Draw a horizontal rectangle on your chart. Step 4. Check the broader market context. Pull up the daily chart of your ticker. Is the market ranging or trending? Ranging means the zone will hold. Trending hard against the zone means it'll break. Step 5. Wait for the retest. Don't anticipate. Don't enter early. Let price actually come back to the zone. When price tags the zone and prints a reversal candle, that's your entry. Stop loss 0.5% past the zone on the other side. Target the previous move. If the rally went 5%, target a 5% move from the retest. 2 checks, 5 steps. Repeat every trading day. The edge compounds. You'll start spotting these setups in real time across every ticker you watch. 2 zone types. Demand bounces, supply rejects. Trade fresh zones only in ranging markets. Drop a comment with a zone you're watching. Catch you next video.